The stock market, a world of opportunity where fortunes are made and dreams are realized. We've all heard the stories, the legends of everyday people transforming into millionaires, even billionaires, by investing in the right companies at the right time. The allure is undeniable, the prospect of turning a modest investment into a life-altering sum. But is this dream still attainable in 2025? Can the stock market still pave the path to extraordinary wealth? The answer, like the market itself, is complex and constantly evolving. The financial landscape of 2025 is vastly different from the Wall Street of old, shaped by technological advancements, global events, and a new generation of investors. The days of exclusive access and insider information are fading, replaced by a more democratized playing field where anyone with a smartphone can participate. Yet, amidst this accessibility, a crucial question lingers. Has the path to riches become easier or more challenging? The desire to achieve financial freedom, to break free from the shackles of a 9-to-5 grind and pursue passions without financial constraints, is a powerful motivator. For many, the stock market represents a path towards realizing this dream, a way to build wealth and secure a brighter future. The traditional route to financial security, working diligently for decades, saving diligently, and hoping for a comfortable retirement, is being challenged by a new generation seeking alternative paths. They crave control over their time and finances, aspiring to build businesses, travel the world, or simply enjoy life on their own terms. The stock market, with its potential for passive income and long-term growth, offers a compelling avenue to achieve these goals. The allure of stock market riches in 2025 is undeniable, but the path to prosperity is not without its obstacles. The financial landscape, shaped by a confluence of global trends and technological advancements, demands a new breed of investor, one who is adaptable, informed, and strategic in their approach. This is not the time for blind faith or get-rich-quick schemes. Success in the stock market of 2025 requires a deep understanding of market dynamics, a commitment to continuous learning, and the ability to sift through the deluge of information and opinions that bombard investors daily. The origins of the stock market can be traced back centuries, to humble beginnings far removed from the high-frequency trading and digital platforms of today. In the bustling port cities of Europe, merchants and traders would gather at designated locations, often coffeehouses or taverns, to exchange goods, share information, and, crucially, finance their ventures. These informal gatherings marked the nascent stages of what would evolve into sophisticated financial markets. One of the earliest formal stock exchanges, the Amsterdam Stock Exchange, emerged in the Netherlands in the 17th century, driven by the burgeoning Dutch East India Company. The company, a pioneer in global trade and exploration, issued shares to finance its ambitious voyages to the East Indies. The early 20th century witnessed both the exhilarating highs and devastating lows of the stock market. The Roaring Twenties, a period of unprecedented economic prosperity and technological innovation, saw the stock market soar to dizzying heights. Fueled by mass production, easy credit, and a seemingly insatiable appetite for consumer goods, stock prices climbed steadily, creating a speculative frenzy that drew in millions of new investors. The allure of quick riches proved irresistible as everyday Americans, from barbers to teachers, poured their savings into the market, often with borrowed money. Margin buying, the practice of borrowing money to purchase stocks, amplified both profits and losses, creating a house of cards built on speculation and debt. The party, however, couldn't last forever. The aftermath of World War II ushered in an era of unprecedented economic growth and prosperity, particularly in the United States. Fueled by pent-up demand, technological advancements, and a surge in consumer spending, the stock market embarked on a multi-decade bull run. Companies like General Motors, Ford, and IBM became symbols of American industrial might, their stocks representing a stake in the nation's economic engine. This period saw the rise of the middle class as millions of Americans gained access to home ownership, higher education, and, crucially, the stock market. Mutual funds, investment vehicles that pooled money from multiple investors to purchase a diversified portfolio of stocks, gained popularity, providing a more accessible and less risky way for ordinary people to participate in the market's growth. Section 4. The rise of globalization and the 2008 crisis interconnectedness and its risks. The turn of the 21st century witnessed the rapid acceleration of globalization, as technological advancements, trade agreements, and the fall of the Iron Curtain broke down barriers between nations, creating a truly interconnected global economy. Emerging markets, particularly in Asia, experienced rapid economic growth, offering new opportunities for investors seeking higher returns. The stock market, once largely confined within national borders, became increasingly globalized, with investors able to access companies and markets around the world with unprecedented ease. This interconnectedness, while fostering economic growth and opportunity, also increased the potential for systemic risks to spread rapidly across borders. Section 5. The tech giants and beyond. A new era of market dominance. In the aftermath of the 2008 financial crisis, a new era emerged in the stock market, one defined by the unprecedented rise of technology giants. Companies like Apple, Amazon, Google, Microsoft, and Facebook, once scrappy startups, transformed into behemoths, their innovative products and services reshaping industries and capturing the lion's share of market capitalization. These tech titans, fueled by network effects, data-driven business models, and relentless innovation, have become the darlings of Wall Street, their stock prices soaring to new heights. Their dominance, while a testament to their entrepreneurial prowess, has also raised concerns about market concentration, competition, and the influence of big tech on society. Section 1. The democratization of investing. The stock market, once a realm reserved for Wall Street elites and financial institutions, has undergone a profound transformation in the 21st century, becoming more accessible and inclusive than ever before. This democratization of investing has been driven by technological advancements, particularly the rise of online brokerage platforms and mobile trading apps, which have empowered a new generation of investors to take control of their financial futures. Gone are the days when navigating the stock market required navigating the labyrinthine corridors of Wall Street firms or engaging the services of expensive brokers. Today, anyone with an internet connection and a smartphone can open a brokerage account in minutes, often with no minimum deposit requirements. This ease of access has removed a significant barrier to entry, allowing individuals from all walks of life to participate in the stock market. The information age has ushered in an era of unprecedented transparency and accessibility in the world of finance. Investors today have access to a wealth of information, from real-time stock quotes and financial news to in-depth company analysis reports and expert commentary, all available at their fingertips. This abundance of information, while empowering, can also be overwhelming, making it challenging for investors to sift through the noise and make informed decisions. Gone are the days when investors relied solely on financial advisors or expensive subscriptions to access market data and research. Today, a plethora of websites, apps, and online platforms provide free or low-cost access to a treasure trove of financial information. Investors can track their portfolios, research companies, analyze market trends, and stay abreast of breaking news, all from the comfort of their homes or on the go. The rise of artificial intelligence, or AI, is transforming the financial industry, bringing about a new era of automated investing and data-driven decision-making. AI-powered tools are increasingly being used to analyze vast amounts of data, identify patterns, and generate insights that would be impossible for human analysts to process alone. This has led to the emergence of robo-advisors, algorithmic trading platforms, and other AI-driven investment solutions that are changing the way people invest. Robo-advisors, for example, are automated investment platforms that use algorithms to create and manage diversified portfolios based on an individual's risk tolerance, financial goals, and time horizon. These platforms typically charge lower fees than traditional financial advisors, making them an attractive option for investors seeking a more affordable and hands-off approach to investing. Fractional shares have emerged as a game-changer for investors, particularly those with limited capital, allowing them to own a piece of even the most expensive companies. Unlike traditional stock purchases, which require investors to buy whole shares, fractional shares allow individuals to purchase a portion of a share, making it possible to invest in companies like Amazon or Tesla with as little as a few dollars. This innovation has lowered the barrier to entry for investing in high-priced stocks, opening up opportunities for individuals who may have previously been priced out of the market. Fractional shares allow investors to diversify their portfolios more effectively, even with limited funds, by spreading their investments across a wider range of companies and sectors. The stock market, by its very nature, is prone to fluctuations. Prices rise and fall, sometimes gradually, sometimes dramatically, reflecting a constant ebb and flow of investor sentiment, economic data, and global events. While volatility is an inherent characteristic of financial markets, it can be a source of both opportunity and anxiety for investors, particularly those new to the world of stock ownership. In recent years, market volatility has become increasingly pronounced, driven by a confluence of factors, including geopolitical tensions, economic uncertainty, and the rapid dissemination of information through social media and news outlets. These factors can trigger swift and significant price swings, leaving investors grappling with the challenge of separating short-term noise from long-term trends. Inflation, the persistent increase in the general price level of goods and services over time, is a pervasive economic challenge that erodes the purchasing power of money and poses a significant threat to long-term wealth accumulation. When inflation is high, the same amount of money buys fewer goods and services, reducing the value of savings and investments. In recent years, after a prolonged period of relatively low inflation, many developed economies have experienced a resurgence of inflationary pressures driven by factors such as supply chain disruptions, rising energy costs, and increased consumer demand. This resurgence has prompted central banks to raise interest rates, aiming to curb inflation but potentially slowing economic growth in the process. In today's interconnected world, geopolitical events can have a profound impact on financial markets, sending shockwaves across borders and creating both risks and opportunities for investors. From trade wars and political instability to armed conflicts and pandemics, geopolitical risk can introduce a high degree of uncertainty into the market, leading to volatility and shifts in investor sentiment. The interconnectedness of the global economy means that events in one part of the world can quickly ripple outward, affecting businesses, currencies, and stock markets far beyond their point of origin. For example, a trade dispute between major economies can disrupt global supply chains, impact corporate profits, and lead to market volatility. Section 4. The interest rate tightrope balancing growth and stability. Interest rates, the cost of borrowing money, play a pivotal role in shaping economic activity and influencing investment decisions. Central banks such as the Federal Reserve in the United States carefully adjust interest rates to maintain price stability, promote economic growth, and manage inflation. However, finding the right balance between these objectives is a delicate balancing act, and changes in interest rates can have significant implications for investors. When interest rates rise, borrowing becomes more expensive for businesses and consumers, potentially slowing economic growth. Higher interest rates can also make bonds more attractive to investors as they offer higher yields, potentially drawing capital away from the stock market. Section 5. The debt dilemma, sovereign debt and global implications. Sovereign debt, the debt owed by a national government, has become a pressing economic challenge in many countries around the world. Governments often issue bonds to finance their spending, and when debt levels become unsustainable, it can lead to economic instability, currency fluctuations, and even sovereign debt crises. High levels of sovereign debt can erode investor confidence, increase borrowing costs for governments, and potentially lead to downgrades in credit ratings. These factors can have ripple effects throughout the global economy, impacting currency exchange rates, trade flows, and investment decisions. For example, a sovereign debt crisis in one country can quickly spread to others, particularly if those countries have close economic ties or are heavily invested in the indebted nation's assets. Section 1. The power of long-term vision. In the fast-paced world of stock trading, where fortunes can be made and lost overnight, it's easy to get caught up in the allure of quick profits. Headlines scream about the latest hot stocks, social media buzzes with trading tips, and the temptation to chase short-term gains can be overwhelming. However, the most successful investors understand that building true wealth in the stock market requires a shift in perspective, a move from short-term speculation to long-term vision. Think of investing like planting a tree. You carefully select a sapling, nurture it with water and sunlight, and patiently wait for it to grow. You don't expect to see fruit overnight. You understand that it takes time for the roots to take hold, for the trunk to strengthen, and for the branches to reach towards the sky. Similarly, building a successful investment portfolio requires patience, discipline, and a long-term perspective. Section 2. Building a rock-solid foundation, diversification. Imagine you're building a house. Would you place all your bricks in one spot, creating a single towering column? Of course not. You'd spread them out, laying a strong foundation that can support the weight of the entire structure. Similarly, in investing, diversification is the foundation upon which a resilient portfolio is built. Section 3. Riding the waves, understanding market cycles. The stock market is like the ocean, vast, powerful, and constantly in motion. Just as the ocean ebbs and flows, the market experiences cycles of growth and decline, driven by a complex interplay of economic factors, investor sentiment, and global events. Understanding these cycles is crucial for investors who want to ride the waves of market volatility and emerge with their portfolios intact. Market cycles are characterized by periods of expansion, where the economy is growing, corporate profits are rising, and investor confidence is high. During these periods, stock prices tend to climb steadily, creating a bull market. Conversely, market cycles also include periods of contraction, where the economy slows, profits decline, and investor sentiment turns bearish. During these periods, stock prices tend to fall, creating a bear market. Section 4. Investing in what you know. In the world of investing, knowledge is power. The more you understand about the companies you invest in, the better equipped you'll be to make informed decisions and weather market storms. While it's tempting to chase the latest hot stock tips or follow the crowd into trendy investments, the most successful investors often focus on what they know best. Investing in what you know is about more than just picking companies that make products you like or understand. It's about leveraging your existing knowledge, skills, and experiences to gain an edge in the market. Section 5. The psychology of successful investing. Investing is often portrayed as a purely rational endeavor, a game of numbers and analysis. However, the reality is far more nuanced. Human emotions, fear, greed, hope, doubt, play a powerful role in shaping our investment decisions, often leading us astray from our long-term goals. Understanding the psychology of investing, recognizing our own biases, and developing strategies to mitigate their impact is crucial for achieving financial success. One of the most common psychological biases that can sabotage our investment returns is loss aversion. Section 1. The Rise of the Machines. Artificial intelligence and its investment potential. Artificial intelligence, once relegated to the realm of science fiction, has rapidly become an integral part of our daily lives, powering everything from virtual assistants and self-driving cars to personalized recommendations and fraud detection systems. This transformative technology is not merely automating tasks, it's revolutionizing industries, creating entirely new markets, and offering investors a glimpse into a future brimming with potential. The investment landscape for AI is vast and varied, encompassing companies involved in developing AI algorithms, building AI-powered hardware, and integrating AI into existing products and services. From tech giants like Google and Microsoft, pouring billions into AI research and development, to nimble startups pushing the boundaries of machine learning and deep learning, the opportunities for investors to capitalize on the AI revolution are abundant. Section 2. Powering a Sustainable Future, Renewable Energy and the Green Revolution. Climate change, driven by the increasing concentration of greenhouse gases in the atmosphere, poses one of the most significant challenges facing humanity in the 21st century. Addressing this global crisis requires a fundamental shift in how we generate and consume energy, a transition away from fossil fuels and towards cleaner, more sustainable sources. This transition, while driven by environmental necessity, is also creating a wave of investment opportunities in the renewable energy sector. The renewable energy market encompasses a wide range of technologies including solar, wind, hydro, geothermal and biomass. Each of these technologies harnesses natural resources to generate electricity without producing greenhouse gas emissions, offering a cleaner and more sustainable alternative to fossil fuels. Section 3. The Future of Health and Wellness, Biotechnology, Genomics and Personalized Medicine. The healthcare industry is on the cusp of a revolution, driven by breakthroughs in biotechnology, genomics and personalized medicine. These advancements are transforming how we diagnose, treat and prevent diseases, offering the promise of longer, healthier lives and creating a wealth of investment opportunities in the process. Biotechnology, the application of biological principles to develop new technologies and products, is at the forefront of this revolution. Biotech companies are developing innovative drugs, therapies and diagnostic tools that target diseases at the molecular level, offering the potential for more effective treatments with fewer side effects. Genomics, the study of an organism's complete set of DNA, is providing unprecedented insights into the genetic basis of diseases, paving the way for personalized medicine, where treatments are tailored to an individual's unique genetic makeup. Section 4. The Metaverse and Beyond. Exploring the frontiers of virtual and augmented reality. The metaverse, a persistent, shared and immersive digital world that blends elements of virtual reality and augmented reality, is rapidly emerging as one of the most talked about and potentially transformative technological advancements of our time. While still in its early stages of development, the metaverse has the potential to revolutionize how we interact, work, play, and even live our lives. For investors, the metaverse represents a vast and largely untapped frontier of opportunity. Companies across a wide range of industries are racing to establish a foothold in this emerging digital landscape, developing the technologies, platforms, and experiences that will shape the future of the metaverse. From gaming and entertainment to education, healthcare, and real estate, the potential applications of the metaverse are virtually limitless. Section 1. The Enduring Potential of Stocks. So, can you still get rich from stocks in 2025? The answer, in short, is a resounding yes. While the stock market landscape has undoubtedly transformed over the decades, the fundamental principles of wealth creation through stocks remain as relevant as ever. The opportunities are there, but the path to success requires a nuanced understanding of the modern market and a commitment to informed, strategic investing. Gone are the days of relying solely on insider information or the guidance of Wall Street gurus. Today's investors have access to a wealth of information at their fingertips, from real-time market data and company analysis tools to educational resources and online communities. Section 2. Embracing the journey to financial well-being. Building wealth through stocks is not about chasing the latest hot stock tips or trying to time the market perfectly. It's about embracing a long-term perspective, developing a sound investment strategy, and staying disciplined in the face of market fluctuations. It's about tuning out the noise and focusing on what truly matters: your financial goals and aspirations. Start by defining your financial goals. What are you saving and investing for? Are you planning for retirement, saving for a child's education, or aiming to achieve financial independence? Once you have a clear understanding of your goals, you can start developing an investment plan that aligns with your risk tolerance, time horizon, and financial situation. Education is key. Take the time to learn the fundamentals of investing, explore different investment strategies, and understand the importance of diversification, risk management, and long-term growth. There are countless resources available to help you on your journey, from books and online courses to financial advisors and reputable investment websites. Remember, investing is not a destination, it's a journey. There will be ups and downs along the way, periods of market exuberance and periods of uncertainty. But by staying focused on your goals, making informed decisions and tuning out the noise, you can navigate the stock market with confidence and position yourself for long-term financial success.